investors are going to want to cash in their stock, and cash in the stock will be a run on the bank, and we can't have that. So we told these investors, sorry, sale, and we gave them some tax credit, and by giving them, and I want to go back to by giving them tax credit, that NOL, by giving them a tax credit, the government now has taken on the liability of the banks. And when we take on the liability of the bank, they can then say, no, it's our job to foreclose, but we don't want anyone to know that, and we'll go ahead and we'll hire these debt collectors and debt collection practice agencies. And I found out that most of them are working under a legal services contract. It's a legal services subcontractor or contractor arrangement.
So, Mayor,
it'd be nice to know that you don't even know who to sue, is what I'm saying. Go ahead, I'm sorry.
So what you're saying is behind every foreclosure, FDIC.
I'm not going to say every foreclosure, but I mean, there's no IndyMac, and IndyMac's out there foreclosing. And no, the FDIC has been open and scoring just to take the assets of these failed banks. Yeah, I am. We are federalized, folks. This is a federalized banking system. Ronald Reagan warned us that the days of capitalism would be gone. That never happened, and it is. I think capitalism, for all intents and purposes, may be gone because our banks are federalized now. But go ahead, Bowie.
I just wanted for you to focus a little bit more on the issue of the note. Like you told me, when they convert the loan into the stock, there is no more of the note. There is no loan, so there is no note behind this loan.
Very eloquent, very well put. Well, I don't. Let me say this. The promissory note in your state is a contract. It's a promise to pay, and unfortunately, the courts, the appellate courts, have not want to hear the predatory claims. So next time you get a loan, remember, caveat emptor, let the buyer beware. I mean, the appellate courts are not going to get a bank for making a bad loan. You should have known better. But the loan is going to be based on the agreement. You sign the agreement. That's what the judges say. You sign the note. And that note is a promise to pay. It's a promissory note. Now, what's attached to the note is your security instrument, which is a mortgage or a deed. And it's a companion document. It really can't be separated, but the note's the promise to pay. So when you're looking at the mortgage, you want to see what kind of terms and conditions they violated. You want to read the note. And if you want to see to what extent they can foreclose on you, then that would be the deed or the mortgage. And basically what you do when you get a loan is you're giving a lender the right to, in advance, you're saying, here's my house. If I miss a payment, take it. You're giving it to them in advance. Now, what they do is they hold it with a third party, a trustee. Okay? So, by answering Oleg's question, I went to the three parties that are going to be involved in this process of where the note go. It's the lender, it's the beneficiary, and the trustee who's holding the deed or the title to your house in case of a default. Okay, and the trustor, who's you? You're the one who made the promise to pay. So, if you take the example again, if you took, and bear with me, folks, because these comparisons may sound silly, but it's the quickest way for the light to go on if you're not familiar with sophisticated types of capitalization. If you took a car and you said to a stockbroker, I want the equal amount, I want an equivalent amount of stock for my car, and I'm going to sell it to you. You're tendering the car. Okay, you're actually tendering the car. You say, I'm giving my car. You're not giving them. You're tendering it, and in exchange, you're getting stock. And the exact amount of stock you get is exactly to the amount or value of the car. That's called your basis. You have a mark-to-market transfer there. Why someone would trade a car in for stock, I don't know, but that's the example. You're trading your car in for stock. So at the end of that day, you have a bilateral agreement, or you have a unilateral agreement, but you have asset going one way and stock coming the other way. So someone woke up with a car in the driveway, someone goes to bed with stock in their bank, the other woke up with stock. Like, you see what I'm saying? That differs. When you talk about lost note, when you talk about the lost note, I've said it over and over again, the note is lost, the note is lost, the note is lost. And people have been asking to produce the note. That's not what that means. The note is lost the same same way. It's late in the ninth. It's 14-0. The Mariners are ahead. They're lost. It's lost. This game's lost. But it's not physically lost. So if you contend a car for stock and stock for car, what happens if you use a car to raise capital? You see, in one we tender the car for stock, and the other we're using the car to put on our balance sheet to raise capital. So if a car is worth $25,000, you can buy $25,000 worth of stock. But if you're going to raise $25,000 in your own company, then you're in one example we say you're buying stock in someone else's company. In the second example, you're raising capital in your own company. And if you do that, your car and pink slip is going to be gone. It's been transferred. It's been transferred into stock. Okay. The car and the pink slip's probably not the best example, but when they take these notes, you either put them in a safe and leave them there, okay, because they're assets, or trade them, if you will, and trade them as they are a tender, as they're a negotiable instrument, which they are. But the only thing is to trade, for them to trade notes and exchange them for stock, you need this national mortgage electronic registration system, and guess what? They got it. They got it. So the note is not necessarily physically lost, but the note is lost to the beneficial interest and the requirement under a UCC for a beneficiary to establish. They have no standing if you challenge them on the note. They have no standing. As George may tell you, though, they're good. They can fabricate and create anything they want. You never know. But you don't want to challenge the physical substance of the note. You want to challenge the merit of the argument that the note is lost. I've spent 25 years in the business, and I've had an interesting career. And I think maybe because of how much I love the business, I've moved from job to job to job in capital markets, secondary, structured finance. I've had some brilliant partners. John Dewey was the one. He did the first. You can look this up too on the SEC site. Continental Grain, Conti. He did the first. I was with him. We did the first. One of the first securitizations ever for a subprime issuance. And it was moderately successful, but Dewey was brilliant. He was next Miller Roos guy from Bear Stearns, and when he left after only 3 years, he really pioneered the securitization you see today. And when he left, he said, "I've had enough." And I said, "Why?" He said, "Because it doesn't work." He said, "If the market ever collapsed, you'd have a Dead Sea, and in the Dead Sea, you'd be able to see that there's no right to foreclosure. You can't foreclose." Along the lines with the note, here's what I'm seeing, folks. Be alert, and this is where if an attorney's in the room, you might want to. I'll stop here in a second, but you might want to comment. I think a real good strategy would be to bring an action against the lender before they go to sale, because when they go to sale, they're going to take some extreme liberties. And the courts are not going to understand, and you are not going to be able to, get up to speed and make what they do is this, okay? Securitization is what Dewey was saying. Securitization is a really messed up process because it rewards a borrower for not making their payments. It rewards borrowers who elect not to make their payments, okay? Because there's nothing to foreclose on. Therefore, you don't have to make your payments. That is not a borrower problem. That's a procedure problem. That shows you that as an accountant, if you want to do a real forensic test, that's what a forensic test shows. It's an ill-gotten conceived concept. So what I'll say is, if there's any attorneys in the room, I'd say that the ability to stop them from doing some of the things they're going to do when they take a house to sale, such as to credit bid, they're going to credit bid your house. They're going to say that that the debt collector or the agent was the purchasing party and that therefore purchased all cash or other credit 100% of the purchase price. Well, beneficiaries, it says the beneficiary is the grantee. The grantee is the winning party. The beneficiary was the lender who George said had standing. First of all, no, there's no beneficiary there. There's a debt collector. He doesn't own nothing. And the grantee is the debt collector for MERS. And nothing's making sense here. So the beneficiary gives the grantee, and a paid all cash for a bona fide sale or on a bid. You don't credit bid. Lenders don't credit bid. Lenders credit bid. The lenders are credit bidding 100% of the high enough to where the vultures probably will pass. There's vulture buyers out there, the bidders. I'm going to price it as low as I can and hope that I don't have to endure any vulture bidders. And if I do get a bidder at 250 and he goes to 3, I'm going to have to step in and go to 325. That is the credit bid. The beneficiary sets the bid price, and it's locked. If anyone outbids them, it's theirs. If the beneficiary wants to keep the house, then they will increase it. These guys are doing a 100% credit bid, and I think you got to go to your attorney general and say, stop it. Stop it. Now, what I was going to say is, if there's an attorney in the room, is that a declaratory relief, and would that be a claim of injunctive relief? No attorneys?
No, there is attorney, but is that a question for him, or what are you trying to ask?
I'm saying, I think to stop the sale, you want injunctive relief and declaratory relief, and have the court, opine as to what the hell's going on here with this credit bid. It doesn't work. From the accounting standpoint, it doesn't work. Anyway, I'm not an attorney. I'm just saying that's what I've seen, and I think if you're going to bring a claim, it would you'd probably want to have your attorney look at the merit of arguing declaratory relief, which is equitable relief, and use that for injunction to stop the sale, and then show that the accounting doesn't work. You don't credit bid 100% of that. Now, the next thing that I see on these deed upon sales, and that's really the advantage I have over you folks. You haven't. God only knows why you want to live the life I live and look at the deeds. It's satisfying to see these beat upon sales, but I started looking at them over and over and over, and I said, my God, this is a fraud. Because I know, the unfortunate thing is that they got a guy here who's been so anal about his career that I was a perfectionist. You don't credit it. And another thing you don't do is say that the grantee and the beneficiary are the same and that they paid zero tax. Now, I wasn't really concerned about that. It wasn't a big deal, but when I told the FDIC this, they flipped out. They said, hey, no transfer tax, how can it be a bona fide sale? You see that FAS 140, remember? FAS 140 said that if you're going to originate a loan and you're going to put them into a security, you got to sell them first. And if you sell them, you say goodbye to them. But if the bank sold the loan, and you're going to love this, folks, if the bank, I sound like the guy who's Paco Nines, but if the bank sold the loan, the rules of FAS 140 and some of the other GAAP and codified rules state that when you sell, you've lost whatever. The only likely or probable way of ever recovering an asset that you sold would be if you sold a car, like we said earlier, and you waved goodbye to somebody, and 6 years from now you're down in San Diego and you see a auction and you decide to go in. Car. There's your car. It's an auction. I mean, those things do happen, and the IRS would say, well, I guess, yeah, okay, you bought it back. And now you got not an adjusted basis, which is accounting terms, but you got an acquisition separate from the sale. And that's what they're doing with the trustee sale. They're saying that they lost the asset to a sale, and they're saying they now were able to recover the asset by bona fide sale, a sheriff's sale or a trustee sale. Well, if there's any, again, attorneys in the room, I'd say, hey, that's a condition subsequent. You're telling me that you're the beneficial interest, you brought the foreclosure, and that you were the beneficiary and the grantee are one and the same, and your fatal mistake is that the beneficiary and the grantee, which normally are the same, tendered a full amount. A beneficiary can't be a grantee and tender something with it lacks the condition precedent. What's the condition precedent? They lost the note. They don't have the benefit of the note. And that's where the lost note comes in. So, again, injunctive relief would have the courts contemplate what the hell they're doing and see that they're just obliterating the basic elements of the law as well as the accounting rules and procedures. So, two more things. On the